Hello, math learners! Our lesson for today is about bonds and loans. The learning objectives for today are: you are going to define terms related to loans, compute for the coupon amount, dividend, and maturity value, distinguish business loan from consumer loan, and solve problems involving loans. Let us have bonds. Bonds or debts represent a loan in the form of an interest-bearing security which promises to pay an amount of money on a certain maturity date as stated in the bond certificate. Bond is an official promissory document from the company to pay the face value or par value to the bond owner at a future date along with the interest payment at a stated rate. When the company or a corporation or any government agency issues a bond, it raises money from investors who then become lenders. They are traded as stock. In case of bankruptcy, the bank holders have the first claim or will get paid before the stockholders. Bonds are essentially loans. Bond holders are lenders to the institution and not entitled to profit sharing. Let us have the comparison between stocks and bonds. Stocks is a form of equity financing or raising money by allowing investors to be part owners of the company. Therefore, stockholders are part owners, while bonds is a form of debt financing or raising money by borrowing from investors. Bondholders are creditors. Stock prices vary every day. These prices are reported in various media like newspaper, TV, internet, and many others. Investors are guaranteed interest payments and a return of their money at a maturity date. Investing in stocks involves some uncertainty. Investors can earn if the stock prices increase, but they can lose money if the stock prices decrease, or worse, if the company goes bankrupt. In bonds, uncertainty comes from the ability of the bond issuer to the bond holders. Bonds issued by the government or corporation pose less risk than those by companies because the government has guaranteed funding, like taxes from which it can pay its loans. In stocks, we have higher risk but with possibility of higher returns, while in bonds, we have lesser risk but yield lower return. Stocks can be appropriate if the investment is for the long term, like 10 years or more. This can allow investors to wait for stock prices to increase if ever they go low, while bonds can be appropriate for retirees because of the guaranteed fixed income, or for those who need the money soon because they cannot afford to take a chance at a stock market. Let us have the basic elements of common bonds. First is dividend. It is the amount of interest. Dividend rate, also known as yield, is the interest rate the bond issuer will be used in computing the interest payment, usually expressed in percent. Coupon or coupon payment is a regular periodic payment of fixed interest on a bond that the bondholder receives during the time between purchase date and maturity date. Coupon dates are interval dates, usually annual or semi-annual, on which the bond issuer will make interest payments. Coupon rate is the rate per coupon payment, denoted usually by R. Par value or face value is the amount stated in the bond payable on the maturity date. It is not the price of the bond. It is used by the bond issuer in calculating the interest. Term or tenor of a bond is a fixed period of time, usually in years, at which the bond is redeemable as stated in the bond certificate. It is the number of years from time of purchase to maturity date. The formulas to be used in solving for problems related to bonds are the following. We have the amount of annual coupon, which is equal to the face value times the coupon rate, or simply F times R. We also have the semi-annual coupon amount, which is equal to the face value times coupon rate over 2, or simply F times R over 2. We have the dividend for each bond for a year is equal to the face value times interest rate, or simply F times R, which is similar to the amount of the annual coupon. And we also have semi-annual dividend for each bond, which is equal to face value times interest rate over 2, or F times R over 2, which is similar to the formula of semi-annual coupon amount. Let us have the first example. Find the amount of the annual and semi-annual coupon for a bond with a face value of 250,000 pesos, which pays 7% convertible semi-annually for its coupons. The given is the face value, which is 250,000. The coupon rate is 7%, equivalent to 0.07. Now we have to find the annual and the semi-annual coupon. For the solutions, first, we have to compute for the annual coupon, which is equivalent to the face value times the coupon rate. So that is 250,000 pesos times 0.07, equivalent to 17,500 pesos. And for the semi-annual coupon amount, we have 250,000 times 0.07 over 2, which is equivalent to 8,750 pesos. So the amount of the annual coupon is 17,500 and the semi-annual coupon is 8,750. Next example. Determine the amount of semi-annual coupon for a bond with a face value of 300,000 pesos that pays 10%, payable semi-annually for its coupons. Given, the face value is 300,000. The coupon rate is 10% or 0.10. You are going to find the amount of the semi-annual coupon. So for the solutions, we have, using the formula F times R over 2, then substitute 300,000 to F and 0.10 to R, then divide it by 2. Then the result is 15,000 pesos. So the semi-annual coupon is amounted to 15,000 pesos. Let us have example number 3. Mr. Abad purchased 100 6% bonds from BC Finance Corporation. Each bond has a face value of 1,000 pesos and was purchased at 960 pesos. The bonds mature in 5 years. First question. How much will Mr. Abad receive as his dividend for all the bonds if the dividends are paid semi-annually? For the solutions, dividend for each bond for a year, that is equivalent to face value times the interest rate. So that is 1,000 times 0.06, which is equivalent to 60 pesos. And for the semi-annual dividend for each bond, we have F times R over 2, equivalent to 1,000 times 0.06 over 2, which is equivalent to 30 pesos. Or simply divide 60 pesos by 2, and that is 30 pesos. For the semi-annual dividend for each bond for 100 bonds, that is 30 pesos times 100, which is equivalent to 3,000 pesos. Let's continue. Another question in the problem is compute for its maturity value. And also, after the maturity date, how much is the total earnings of Mr. Abad? For the solutions, first we will have the maturity value of 100 bonds, which is equal to 1,000 times 100. So, the maturity value is equivalent to 100,000 pesos. And for the earnings, that is equivalent to the maturity value plus the total dividends minus the purchase price. So, for the maturity value, it is equivalent to 100,000. The total dividends that we had earlier is 3,000. And the purchase value is 960 times 100 bonds. And 100,000 plus 3,000 is 103,000 minus 96,000, which is the result of this. So, it is 7,000. So, the total earning of Mr. Abad is 7,000. Next, let us have the basic concepts of loans. First, let us start with the definition of terms. Business loan is the money lent specifically for a business purpose. It may be used to start a business or to have a business expansion. Consumer loan is the money lent to an individual for personal or family purpose. Collateral is an asset used to secure the loan. It may be real estate or other investments. Term of a loan, the time to pay the entire loan. Let us have consumer loans first. Consumer loans are loans given to individuals for personal or family purpose. Consumer loans may require a collateral. The collateral may be real estate or other investments. Consumer loans do not usually require a guarantor. For consumer loans, the bank or the lending institution may require a credit report, bank statements, and an income tax return. And if the borrower is employed, a certificate of employment and employee pay slips are required. For business loans, it may require a collateral. They can use equipment, fixtures, or furniture as collateral. The collateral may be real estate or other investments. Business loans require the business owners to sign as guarantors. For business loans, the borrower has to submit a credit report, income tax returns, and company's financial statement. The term of the business loan is generally shorter than the consumer loan. The interest rate for the business loan is usually higher than that of the consumer loan. Let us identify whether the following is under a consumer loan or a business loan. Number 1. Mr. Bintulan plans to have a barber shop. He wants to borrow some money from the bank in order for him to buy the equipment and furniture for the barber shop. Is it a consumer loan or a business loan? And the answer is a business loan. Next, Ms. Remolio wants to borrow money from the bank to finance the college education of her younger brother. Is it a business loan or a consumer loan? And the answer is a consumer loan. Next, Mr. Marata wants to have some improvements on their 10-year-old house. He wants to build a new room for his younger sister. He will borrow some money from the bank to finance his plan. Is it a consumer loan or a business loan? And the answer is a consumer loan. Next, Mr. Lakutab owns a shumai food cart business. He wants to put another food cart on a new mall in the other city. He decided to have a loan to establish the new business. Is it a consumer loan or a business loan? And the answer is a business loan. Next, Ruan has a computer shop. She owns 6 computers. She decided to borrow some money from the bank to buy 10 more computers. Is it a business loan or a consumer loan? And the answer is a business loan. Next, let us have definition of terms. First, the amortization method. It is a method of paying a loan or principal and interest on installment basis, usually of equal amounts at regular intervals. Next, mortgage. It is a loan secured by a collateral that the borrower is obliged to pay at specified terms. Collateral. Assets used to secure the loan. It may be a real estate or other investments. Outstanding balance. Any remaining debt at a specified time. Let us have mortgage. A mortgage is a business loan or a consumer loan that is secured with a collateral. Collaterals are assets that can secure a loan. If a borrower cannot pay the loan, the lender has the right to the collateral. The most common collaterals are real estate property. For business loans, equipment, furniture, and vehicles may be used as collaterals. Usually, the loan is secured by the property bought. For example, if a house and lot is purchased, it will be used as a mortgage property or a collateral. During the term of the loan, the mortgagor or the borrower in a mortgage still has the right to possess and use the mortgage property. In the event that the mortgagor does not make regular payments on the mortgage, the mortgagee or the lender can repossess the mortgage property. The most common type or mortgage is the fixed rate mortgage, wherein the interest remains constant throughout the term of the loan. Let us have the formulas to be used in solving this kind of problem. Final amount is equal to P times the quantity 1 plus R raised to T. We have the total interest, which is equal to F minus P. Down payment is equal to down payment rate times the cash price. The amount of the loan or the amount of the mortgage is equal to the cash price minus down payment. Let us have a problem. Mr. Aying borrowed 1 million pesos for the expansion of his business. The effective rate of interest is 7%. The loan is to be repaid in full 1 year. How much is to be paid after 1 year? Let us have the given. P or the principal is 1 million. R is 7% or 0.07. T is 1. That's for 1 year. We are going to find F, which is the final amount. So the formula is F is equal to P times the quantity 1 plus R raised to T. So all you have to do is to substitute 1 million times 1 plus 0.07 raised to T, which is 1. So you need not reflect it. So the answer is 1,070,000. So the amount of 1,070,000 pesos must be paid after 1 year. Example 2. For the given, we have P, 1,200,000. The monthly payment is 31,000 pesos. We are going to find the total interest. So for the solutions, first, total amount, that is 31,000 times 12 months times 5 years. That is good for 5 years. So the total amount is 1,860,000 pesos. Next, for the total interest, that is 1,860,000 pesos minus P, which is 1,200,000 pesos. So the result is 660,000 pesos. So the answer, the amount of the total interest is 660,000 pesos. Note, the total interest is the difference between the total amount paid and the amount of the mortgage. Next problem. If a house is sold for 3 million pesos and the bank requires 20% down payment, find the amount of the mortgage. Given cash price is 3 million pesos, down payment rate is 20% or 0.20. Solutions? First, we have the down payment that is equivalent to down payment rate times cash price. That is 0.20 times 3 million, equivalent to 600,000 pesos. So the down payment is 600,000 pesos. Next, the amount of the loan, cash price minus down payment. So 3 million pesos minus 600,000 pesos, that is equivalent to 2,400,000 pesos. Therefore, the amount of the mortgage is 2,400,000 pesos.